With the end of the year rapidly approaching, I want to talk about two key components that investors and consumers can think about leading into 2025. The first one I want to talk about are equities and the equity outlook for next year. And the second category that I want to talk about are bonds and the outlook for bonds for next year as well. So let's dive right into equities. So equities have been on a tremendous bull run over the last 3 years now. And what does that mean and what should we expect? Well, historically, stocks that have a bull run leading into 3 years or longer and don't suffer any sort of recession or major pullback due to economic reasons historically tend to lead into a fourth year. So this is actually a really good sign for stock markets. We may not necessarily see the tremendous growth of the last 2 years. We saw really back-to-back years of double-digit returns. The economy is slowing down. So it's likely that stocks will continue to trend upward. However, it's not likely that stocks will continue to see these crazy years of 20, 30% year over year returns. I think that is a pretty unlikely scenario. But overall, corporate valuations still look good. The US economy is still chugging along very nicely, but it is slowing down. Labor growth is slowing down. And really the pressure that inflation has caused is continuing to keep some pressure on the economy to keep it at a slower growth rate. So keep that in mind over the next year. Again, I think stocks are still very attractive for a lot of investors that are looking to engage in stocks as a part of their portfolio. But I do think it is likely that we won't see the same level of these lovely 20% returns that we have gotten somewhat accustomed to. Now, with that in mind, let's talk about the near-term future of 2025 and what the first quarter might look like. And honestly, I think there's a pretty good chance that we'll see some sort of pullback. We're already very due for a pullback in the stock market as it is. Pullbacks are very normal and actually healthy occurrences for stock markets. Think of it as if you're running a sprinting race, right? Anyone that has sprinted in their life or run a quarter mile around a track loop knows that by the end of their sprint, the end of that quarter mile, they are out of breath, right? They need to typically stop, maybe just do a slow pace at a walk. Around the next lap, they need to catch their breath, and then they're good to go, and they can go sprint another lap. And markets work in a very, very similar way. They tend to, especially in sprinting situations, which we've been in, they sprint. They run out of energy. They need to catch their breath, AKA they have a pullback, and then they have that pullback, and then they're good to go to continue their bull run. So I think that's what's honestly pretty likely. And I'm going to throw a chart on the screen here, but consumer sentiment is at an all-time historical high going back from the 1980s. About 60% of people think that stocks will continue to be in a bull market over the near future. So with this chart in mind, it's just a good indicator that being that consumer sentiment is so high, there's a little bit of a checks and balances system here that's going to say, okay, we're going to shave off some of this sentiment a little bit and get back to more realistic levels around maybe 30 or 40% of consumers thinking that we will continue to have a bull market, which is at a more normal level. So again, stock markets will likely do well into 2025, but we are likely to have some sort of pullback, I think probably within the first quarter of the year, especially since there will be a lot of change around the presidential election. There's going to be a change of power with Donald Trump coming into office. And there's been some end of year geopolitical tensions globally that I think need to be addressed, and markets will take that into account. So transitioning over to part two, the bond market. So the Fed has been a key player in the bond market and interest rates. As we know, we've talked about this a ton over the last year plus. Let's talk about it a little bit more because they are now transitioning from their rate hike cycle to their rate easing cycle and rate reduction cycle. So the Fed recently did a rate cut of 50 basis points. And I personally thought that that was a little overzealous. I think the Fed needs to be a little bit more mindful of the rate cuts. I'm not opposed to them doing rate cuts by any means. I think that the economy is getting to a point where we can start to take this into account and really welcome some rate cuts. But inflation is still here. Inflation has come down a lot, but it's still modest. It's way above the target of where the Fed wants to be. Historically, the Fed wants inflation to be at 2%. And this is the CPI index that they're looking at. And inflation right now is still at about 3.5%, 4%. So it's about double to where their target is. And the Fed, I know, really wants to lower rates and they want the economy to flourish. They don't want the economy to stagnate, which I completely understand. But there is no reason to sprint into this, continuing the conversation of running. I think the rate cut cycle needs to be a marathon and not a sprint. And we saw that inflation elevated very, very quickly during the COVID pandemic. And that was due to a number of reasons because the economy very quickly shut down and it was a huge global supply chain interruption that we have never seen before. And there were two massive stimulus packages put into place under the Trump administration and then under the Biden administration. And both of these stimulus packages just created a huge supply of dollars, and that caused inflation to continue to spike even further. So we're not going to debate whether that was the right decision or the wrong decision. It's just what happened. So with the Fed and what they're going to do, I think they just need to be more careful of the interest rate cuts. Now, for bond investors, what does this mean, right? What decisions can we make when it comes to buying bonds? If bonds are a part of your portfolio, then I think that's great. I think yields will still be very attractive in 2025. I know some high yield savings accounts and CD rates, a lot of them have come down already. We no longer can go get a 5% CD, but we can still typically find her in the 4% ballpark, maybe a little bit lower, a little bit higher, depending upon the financial institution that you're working with. But I still think bond yields will still be very attractive. Bond yields will still probably be able to find 5, 6, maybe even 7%, depending upon the credit rating of the issuer. And in order to maybe curb some risk associated with bonds, right, there is going to be interest rate risk throughout the year as the Fed makes decisions on interest rates and global rates are affected as well. So what can bond investors do? And bond investors can limit some of their exposure to intermediate bond durations, meaning looking at bonds that don't have the maximum duration. You're typically ignoring 30-year bonds, you're ignoring 20-year bonds. But you might say, I still want bonds in my portfolio because they tend to be historically more stable than equities. And right now they're generating very attractive yields. So this is where a lot of bond investors can look to intermediate bonds, maybe in the 3, 5, or 10-year space, or any combination in between. But I still think that will be a great way for bond investors to take on some risk in the bond market, but also limit their total exposure because bonds are very sensitive to interest rate change. So if bond risk is a concern, which I don't think it necessarily needs to be a concern, but if it's just on your radar and you're looking to limit some of the risk associated with bonds over the next year, then reducing your duration will be a great way to help limit some of that risk. So again, we have the equity markets for next year. In a recap, I think the equity markets will continue to still do well, but I don't think they will do as well as they've done over the last couple of years. And there's likely to be a pullback somewhere in the mix, maybe one or two. And then recap of the bonds. Bond yields are still very attractive. They're still more attractive than cash and CDs. And if you're looking to limit some of your exposure, then just consider limiting your duration on bonds from long yield and looking more toward intermediate duration bonds or short-term duration bonds. So thank you so much for watching today's video. I know we are wrapping up at the end of the year, and I look forward to having more conversations with everyone about our outlook for 2025.